time is running out for you to do something about your next tax bill. So if you own a business or earn any non-employment income, whether it be through a 1099 contract or side gig, and you don't want to pay the IRS thousands more than you have to, then stick around because I'm about to give you a very simple framework to find opportunities to reduce your taxes right here, right now. As a licensed CPA, I have used this framework to save my clients millions of dollars in taxes at mycpacoach.com. And today you are going to learn that for free. So do me a favor and go ahead and like this video, drop your feedback in the comments below, and get ready to learn some tax slashing strategies. Okay, so if I were your CPA and my job were to reduce your taxes, the very first thing I would do is look for missing tax deductions. 90% of taxpayers overpay on taxes because they fail to deduct things they already pay for, which is big because tax deductions lower the amount of income you report on your tax return. And the less income you report, the lower your taxes would be. So my first step would be to take a look at all of your expenses, including your major household expenses like housing, food and dining, vehicle and transportation costs, healthcare, childcare, education expenses, and so on. But then I would look at the tax code to find the best ways to write off those expenses. For example, as an individual, you can write off your medical expenses, mortgage interest, property taxes, charitable contributions, and more as an itemized deduction on your tax return. But then as a business owner, you virtually have the ability to write off almost any expense as long as it is helpful for operating your trade or business, opening the door for you to take hundreds of additional deductions. For example, you can write off portions of your housing expenses, dining expenses, travel and vehicle expenses, and so on if those expenses relate to your business. Plus, you can also set up benefit plans and reimbursement plans under your business to write off portions of your education, childcare, or health expenses under the right structure. But it all starts with an in-depth analysis of where your money is already going, and then you can use the tax code to find the best ways to use those expenses as write-offs to lower your taxes. Now, I recommend starting with this because finding tax deductions is not something that costs you more money out of your pocket. Plus, finding just one tax deduction could save you thousands more in taxes. But for now, let's move on to the second major area of opportunity here, creating tax deductions. So once you have found all of the deductions you qualify for, the next thing you may want to consider are opportunities to create tax deductions. Now, you can create tax deductions by strategically spending or investing your money, and I'm going to show you several ways to do this over the next few opportunities here. But remember, in the last step, we were just finding deductions by looking at the past and expenses you've already paid for. Creating tax deductions is about looking into the future at things you expect to pay for in the future and trying to write that off this tax year before it ends. Now, for this, it is important to act on this before the year ends because once tax time comes around, it will be too late. So let's make sure you understand this. Okay, so if you operate a trade or business, you can create tax deductions in a number of different ways. One of the most powerful ways is to leverage income shifting strategies, which involves you shifting some of your income to sources that have lower tax rates. Common examples of this include hiring your children to shift income to their lower tax brackets, renting your personal residence to your business to create a tax deductible rental expense, or moving money to entities taxed at lower rates, such as C corporations, which are taxed at lower rates than individuals. Now, when you move money out of your business for any one of these reasons, the amount you spend is tax deductible for the business and therefore reduces your taxes. And ideally, the party receiving the funds will be taxed at a more favorable rate because they are either taxed at a lower rate, like children or corporations, for example, or the income is tax-free due to provisions in the tax code, such as the Augusta rule for home rentals or the standard deduction for children, for example. But outside of income shifting strategies, another way you can create tax deductions under your trade or business is by prepaying expenses before the year ends. Most taxpayers report income and expenses on a cash basis, which simply means they report income when they receive cash and they report expenses when that cash leaves their account. So if there are tools, services, subscriptions, supplies, or any expense for that matter that you expect to pay next year or in the future, you can simply prepay those expenses before this year ends to create a tax deduction, which could save you a pretty penny in taxes. And I even have clients who rationalize making big purchases for things like equipment, machinery, or even vehicles to create big tax deductions before the year ends because they expect to have those expenses in the future anyway. But outside of spending money, you can also create tax deductions by deferring or sheltering your income, which is such a big opportunity that it deserves its own category. So let's talk about number 3, deferring taxes. Now, I like to think of tax deferment as pushing income that would otherwise be taxed this tax year far, far into the future in tax years where you may be in a much lower tax bracket. And to accomplish this, all you would have to do is use qualified saving vehicles, such as retirement accounts, health savings accounts, or charitable savings accounts, as I like to call them, just to name a few. And if you are in a very high tax bracket like right now, the general rule would be for you to max out these accounts if you can, or put as much money in them so that you can pay the least amount of taxes when that time comes. But let's walk through some examples, starting with traditional retirement accounts. So at the time of this video, you can defer up to $23,000 of your employee wages into a 401k account, or about $30,000 if you are over 50. And if you're self-employed, you may be able to put another $46,000 into your 401k as an employer. But if for some reason you wanted to go beyond these limits, you could. You could set up what is called a defined benefit plan, which would allow you to put anywhere from $100,000 to $300,000 towards your retirement in one given year, depending on your age and income. Now, this basically works like a pension, but there are various types of defined benefit plans. So if that's something you're interested in, just drop a comment below and I'll create a separate video to address that specifically. But beyond retirement accounts, you can also defer your income by moving money into health savings accounts. And you can think of this like a piggy bank for your future health expenses. Except the government gives you a tax deduction for moving money into these accounts. And when you take the funds out to pay for qualifying health expenses, they also come out tax-free. Now, at the time of this video, single taxpayers can put about $4,100 into their HSA, or $8,300 if they have a family plan. But you do have to have a high deductible health insurance plan to qualify. And lastly, if you donate to charities, you may also want to consider setting some money aside for your future charitable giving this tax year to create a deduction. And you can accomplish this with a donor advised fund or private foundation. And when you put money into one of these vehicles, the tax law grants you a charitable tax deduction, which you can then use on your tax return to offset your taxes. And the limits are pretty high. You can write off up to 30% of your income for donations of non-cash assets and up to 60% of your income for cash donations. Now remember, all of these are just qualified savings accounts at the end of the day that allows you to push income off of this year's tax return into the future, okay? So that's what we're trying to accomplish here. But remember, there may be additional rules, strategies, or types of accounts you need to consider when setting this up. The bottom line is that if you want to reduce your next tax bill right now, just look at all of your tax deferral options and choose the ones that best fit your goals. Now let's move on to the fourth major area of opportunity here, making tax deductible investments. So once you have maxed out your retirement and other tax deferred accounts, it can feel like there's nothing else you can do to reduce your taxes. But that's not true. Outside of qualified saving accounts, you can also invest into specific assets that are favored by the tax code and can therefore reduce your taxes. And what I love about these types of assets is that there is virtually no limit in terms of how much of your money you can invest in them, unlike the limits imposed to you with retirement and health savings plans. So let's talk about the top 3 tax-deductible investments that you can make before this year ends. Number 1, rental real estate. When you own rental properties, the tax law allows you to write off a portion of your property's cost every year through depreciation. And there are even ways to accelerate the rate of depreciation you take to the point to where you can write off literally 20% of your property cost in the first year. For example, if you purchase a rental property for $300,000, you could potentially create a $60,000 deduction on your tax return to offset your rental income and even show a loss that can then be used to offset other income on your return. But in order to do this, you would need to meet certain criteria and use more advanced methods to calculate depreciation, which is something that I would talk to your CPA about. Number 2, oil and gas investments. So when you invest in a qualifying oil and gas company that conducts drilling operations, the tax law allows you to write off up to 65 to 85% of your investment in the first year. Plus, the machinery and equipment used may also qualify depreciation tax benefits similar to what we see with real estate. But unlike real estate, it's easier to use these losses to offset income on your tax return. You don't have to meet certain criteria or buy expensive depreciation studies. But usually with oil and gas, you have to invest into a private company as an accredited investor, which some people may not qualify for. But if you want to learn more, I have a separate video that goes into great detail about this, so subscribe and check that out. Number 3, business investments. So when you invest into a business, the funds spent by that business is tax deductible, which will therefore reduce your business taxes. But if by chance your business incurs a loss, that business loss can also be used to offset other income on your tax return, such as your W-2 income, for example. But usually we are not investing in a business to show a loss. We're investing to grow the business profits and increase our income as shareholders. Therefore, typical uses of the business investment are into things like additional advertising campaigns to boost revenue, research and development to build new products, processes, or services, or even hiring staff and consultants to help you scale and grow your business. So if you want to reduce your taxes but feel limited by any of the options we covered so far, then consider incorporating more of one of these 3 investments. There's virtually no limit to what you can do here. But there is one last tax strategy you should consider if you want to pay the absolute least amount of tax. And that is number 5, shielding your income from additional taxes. When you earn business or non-employment income, you have the ability to change how your income is taxed by simply changing your business entity structure. For example, pass-through entities like LLCs, partnerships, and sole proprietors pay a 15.3% self-employment tax on their business income. But S corporations and C corporations do not pay self-employment tax at all. Another key tax difference is that all of your business income is taxed to you on your individual tax return, typically, with the exception of C corporations. And at the time of this video, individual tax rates can go up to 37%, but corporate income tax rates only go up to 21%. That's a 16% difference. But shareholders of C corporations are subject to double taxation. They are taxed once on a corporate level, and if they take any dividends from the C Corp, they are taxed again as an individual. But there are even ways to get around the double tax as well. Ultimately, I share all of this to illustrate one simple point. There are major tax differences amongst various business entities. And when tax differences like this exist, it is important for you to choose the tax difference that results in you paying the least amount of tax. Typically, for new business owners with low revenue, an LLC may be most appropriate. And once your business earns more income, an S Corp may be more appropriate to reduce your self-employment tax. But once your individual tax rate effectively exceeds 21%, using a C corporation in some way may be appropriate. For some of my higher income clients, we use a mix of all of these entities to maximize their tax savings. But the bottom line here is that if you earn business income subject to tax, Make sure you choose the best entity structure before this year ends to avoid paying additional unnecessary taxes. And if you need help with that or any of these tax strategies, just apply to work with one of my CPAs today at mycpacoach.com.